Welcome to the Pro Ticker Deep Dive. For the last 30 years or so, the playbook for commodities was pretty simple. You follow the cycle, you follow demand, and you optimize everything for cost.
Exactly.
But the year 2025, it's just a totally different world. If you're still using that old playbook, you are fundamentally not ready for what's happening.
That's the key thing we have to get across today. It's not just about, is global growth up or down
Right,
anymore.
right.
The real question now is what happens when geopolitics just fractures global trade on purpose? When supply chains are actively being unwound for security reasons and defense budgets are just exploding.
And we're talking big numbers.
Huge. A projected 15% jump in U.S. defense spending for fiscal 26
Yeah.
as a direct signal to the market.
And here's the part that's so fascinating and honestly a bit of a distraction. Our sources are showing that the aggregate commodity index, it's actually forecast to fall next year.
Right, by about 7%.
Yeah, 7%. And if you just read that headline, you'd think, okay, cyclical downturn, recession's coming.
But that single number just completely hides what's really going on. We are not in a simple cyclical downturn. We're in a massive transformation that's ripping the market in two.
Exactly. It's a completely bifurcated reality. And we've identified two really seismic shifts that are pulling prices in totally opposite directions. It's creating winners and losers with, extreme prejudice.
So the first big one is de-globalization. And this isn't some accident. It's the deliberate dismantling of those super optimized just-in-time supply chains.
The ones that valued efficiency above everything else.
Right. And now companies are explicitly moving to reshoring, nearshoring, anything for resilience.
And the second shift is the defense mobilization. Global defense spending is just skyrocketing, which forces governments to look at raw materials in a new way.
They're not just economic inputs anymore, like something you put in a car.
No, not at all. They're critical strategic assets in a new global competition. When you start weaponizing trade, commodities become security risks. So that's our mission today. We need to cut through all that noise and give you clarity. You need to know which assets are the real safe havens now, which are pure defense plays, and which ones are just stuck in the middle.
Okay, so let's unpack how we got here. The old model, the one that pretty much dominated since the 90s, was all about efficiency.
Move production to the lowest cost country, which was almost always China.
Right, without much thought to political risk. And that model, it worked for a while, until about 2020.
And then its fragility was just completely exposed during the COVID lockdowns. Then, with Russia's invasion of Ukraine, the geopolitical risk became, undeniable.
Absolutely. It immediately cut off critical supplies to Europe.
And now it's really industrial policy and these trade disputes that are cementing this change for the long term. The shift in U.S. policy is the clearest signal you could ask for.
Nations are now actually willing to pay a much higher price for supply chain security. Literally.
You can see it in the tariffs. The
Yeah.
proposed U.S. duties are anywhere from, 10% up to 60% on some Chinese goods.
Yeah, and with specific threats aimed at key materials like copper and, of course, rare earths. This isn't just a temporary spat.
No, this is a clear, long-term signal that the race to the bottom on cost is over. Resilience is the new metric.
And that directly creates what we're calling the supply premium. What this means for your portfolio is that companies with assets, say mines or processing plants, in geopolitically stable places.
Like Canada, Australia.
Australia, even certain parts of Latin America or Africa that are stable democracies, they suddenly command much higher valuations. That stability, that resilience is now priced as a premium asset. It outweighs the marginal cost of production.
That makes total sense. The market is shifting from valuing cheap to valuing secure. But let's anchor this in the defense mobilization, because it's almost jarring to see something like national defense suddenly so dependent on these commodity markets.
It is, and the speed of this rearmament is just unprecedented. Look at Europe. Germany, right? The historic anchor of fiscal conservatism literally overrode its own constitutional debt ceiling to fund its military.
That's a massive shift in priorities.
It's fundamental, and the European Commission kicked off the Rearm Europe plan, which is basically this huge, coordinated push to boost Europe's own domestic military output.
So they can be less dependent on foreign supply.
Exactly, especially for these essential raw materials.
And the really critical piece of evidence, the smoking gun, arrived in December 2024. NATO published its first ever list of 12 defense-critical raw materials.
That's an unprecedented move. It's like putting a giant spotlight on the vulnerability of allied military supply chains. It tells you that military needs are now driving commodity strategy.
So when a military alliance publicly says, hey, we're vulnerable and here are the specific things we need, the market has to listen.
You have to pay attention. This move from just policy talk to governments actively mobilizing resources is the single biggest demand driver in these specific metal markets right now.
Okay, so this mobilization really creates our two separate market stories. You've got the safe haven trade, which is driven by fear, and the industrial conflict, which is all about this policy friction. Let's start with the defensive side, precious metals.
Yeah, the safe haven trade is performing exactly like you'd expect it to when the post-World War II financial order starts to show cracks. Gold was hitting all-time highs through 2024 and into 2025.
And this isn't a small move we're talking about.
Oh no, gold is projected to increase by a staggering 42% in 2025. That's nearly double the average price we saw between 2015 and 2019. And silver's right there with it, projected up 34%.
And the driver here isn't, classic inflation or people buying more jewelry.
No, it's pure geopolitical and monetary hedging. Central banks are buying gold at record rates. They see it as the ultimate insurance policy against currency debasement and, a breakdown in global order.
It's a hedge against the system itself.
Exactly. And technically, the chart just confirms this is a structural move, not just noise. Gold had a textbook breakout above its multi-year resistance. Momentum is strong. Although, we have to admit the positioning is getting a bit crowded.
So what's the key level to watch?
The key takeaway is that old resistance has become the new floor. That support is sitting firmly in the $2,000 to $2,200 range. Any near-term de-escalation could cause a sharp pullback, sure, but that support level suggests the long-term trade is anchored much, much higher.
Okay, so central banks are running to gold for safety. But what about the metals that actually have to go into things, into infrastructure and manufacturing? Let's pivot to industrial metals because they are caught right in the middle of this. Copper, especially.
Copper is the poster child for this policy friction. On one hand, you've got genuinely tight supply, especially from places like Chile. That tightness pushed prices up to a high of, $5.94 a pound back in July 2025. It's trading around $5.37 now.
But here's the conflict, right? Copper is absolutely essential for the energy transition. You need it for EVs, for renewables, for everything.
For everything. But those long-term demand drivers are getting undercut by short-term policy shifts, particularly the political headwinds that favor fossil fuels at the moment.
And on top of that, you have weak global growth, especially out of China,
which just dampens immediate industrial demand. The technical chart shows this confusion perfectly. Prices pulled back about 11% from that July high.
which is a huge divergence.
It is. Tight supply should be keeping prices high, but the drop suggests the market is pricing in demand fears, either a global slowdown or a policy-driven stall in the energy transition. The line in the sand for copper is at $5 to $5.20 range. A sustained break below that would be a bad sign.
A very bad sign. It would signal that demand problems are so big that even supply deficits can't prop up the price. All right, so let's talk about where the structural certainty does exist, and that's in these defense-critical materials. These aren't cyclical bets, they're strategic necessities.
This brings us right back to that NATO list. We're talking about things like gallium and germanium, which are essential for high-performance military radar and night vision.
And industrial stuff too, right?
Yeah, things like specialized graphite, cobalt, rare earth elements, tungsten, lithium, titanium. These are the basic building blocks for modern military power, for jets, missiles, tanks, everything.
And the immediate, really urgent problem is the China choke point. It's not just about who mines the ore.
No, it's the processing. West is trying to diversify mining, sure, but China controls something like 70% of the global processing capacity for rare earths.
And they've shown they're willing to use that as a weapon.
Absolutely. They've already used export controls to retaliate. If they limited exports of, say, tungsten or graphite, it would immediately throttle manufacturing in allied countries.
So this creates a massive and long-lasting deficit. Defense budgets are rising 15+% a year, so demand is guaranteed.
But supply capacity outside of China is growing so slowly. NATO's own estimates say that existing allied supply chains just can't meet the procurement targets they need to hit.
The implication for you as an investor is just crystal clear. These aren't your typical commodities. They are strategic assets. Producers of graphite or tungsten or cobalt in reliable places like Australia or Canada.
They suddenly have incredible pricing power. They get multi-year contracts directly with governments. They're trading on geopolitical security, not on global GDP.
Okay, shifting gears a bit from metals. Let's look at energy. It's showing its own pretty wild set of divergences. Surprisingly, crude oil has a pretty clear negative outlook for next year.
Yeah, it's a pure oversupply story. JP Morgan is forecasting a 1.3 million barrel per day global surplus in 2025,
Wow.
and they see Brent averaging around $73 a barrel. The culprits are pretty simple. Robust production from the Permian in the U.S., plus massive new offshore capacity from Guyana and Brazil.
You pair that with sluggish demand from China, and you've got a recipe for lower prices.
Exactly. Technically, oil is in a clear downtrend, trading below its key moving averages in that $70 to $76 range. The path of least resistance is lower.
But the geopolitical risk is kind of a floor, right?
It is. The constant risk premium from the Middle East is preventing a catastrophic drop into the 50s that the fundamentals might otherwise suggest.
But here's the big disconnect, the real energy wildcard: natural gas. While crude is drowning in supply, LNG is really strong.
It's buoyed by huge European and Asian demand. And this demand is tied right back to that defense narrative. It's about rearmament, energy security, and the permanent reduction of Russian pipeline gas.
That's a perfect example of this fragmentation. Crude reacts to physical supply, nat gas reacts to a political crunch. And I guess agriculture is also in its own world of volatility.
Very much so. It's all driven by unpredictable weather and the political risk for these escalating trade wars.
Like with soybeans.
Soybeans are a great example. The volatility there is squarely from U.S.-China trade tensions and tariff threats. It's policy risk driving the price, not stable demand.
And things like cocoa and coffee.
Well, they saw record highs of extreme weather in 2024, but they're forecast to fall pretty sharply as global supply starts to catch up to those high prices.
Yeah.
For agriculture in 2025, it's purely a risk management play, not a growth story.
Okay, so let's try to pull all this together. The new playbook, it really demands specificity. It demands geopolitical awareness. The market is fragmented, and if you just rely on a general commodity index, you're going to get burned.
Severely.
So the structural bull case seems to rest on three pillars. First, the defense critical materials. Your graphite, your rare earths. They have the biggest long-term tailwind.
Guaranteed supply deficit plus accelerating government demand, a powerful combination.
Second, the supply premia. It's real. A Canadian copper mine should be valued higher than a Peruvian one, all else being equal, just because of that security.
That's a fundamental change in how we price risk. It's here to stay.
And third, gold. It remains that non-negotiable structural hedge against geopolitical chaos and currency fears. The record buying from central banks provides a really powerful floor under the price.
But we have to be disciplined about the risks. The World Bank's 7% aggregate price decline forecast. That's a real headwind for any traditional industrial demand.
Right, for anything not labeled strategic.
Exactly. And a strong U.S. dollar keeps pressure on everything, and you just can't model the chaos that tariffs and trade wars can create.
So the market today, it rewards that awareness, that discipline to see the difference between a durable trend and just cyclical noise. To leave you with a final thought, consider this scenario. If we accept that these materials are now basically weaponized strategic assets, which of those 12 NATO critical materials is the most vulnerable to an immediate total Chinese export ban? And what would the impact be globally the very next morning?
That's the kind of strategic thinking that gives you an edge right now.
See you all in the next Pro Ticker Deep Dive.